we have to cover a special case of deferred expenses. If you recall, deferred expenses are when we purchase something and then use it later. We came up with the examples of insurance and rent and supplies. Those are all things that we buy ahead of time and then we use up later. Another example of a deferred expense is equipment or buildings or furniture. These things are assets that are long-lived, so they last us a long time, usually over years. And we use it up, but we don't actually get rid of it until maybe the very end. So there are a couple of things here that special cases that we need to pay attention to. So let's just say that we bought some equipment for $50,000. And we say that this equipment is going to last us 5 years. And the technical term for that is it has a 5-year useful life. Now, what we're going to do with that is you can probably do the math here. It's kind of intuitive at this point. We say, well, how much do we use up per year? We say, all right, we have $50,000. It's going to last us 5 years. That's $10,000 per year. And we'll come back to that calculation in a little bit. Now, we say, what's the original journal entry? The original journal entry is we bought equipment, which is an asset of $50,000. And just to make this easy, let's say that we bought it for cash. So we spent cash of $50,000. So debit the equipment, credit the cash. At the end of the year, let's say we bought that January 1st and we come to December 31st and we have to, we're going down our trial balance and saying, hey, is this right? Do we still have $50,000 worth of equipment? And the answer is, hey, we used up part of that. And you might say we used up $10,000. So I always like to start off with the pattern that we did in the deferred expenses where we debit some sort of expense. So let's, when we were doing supplies, we said, well, it's supplies expense. When we did insurance, we said, well, that's insurance expense. So we're going to be tempted to say, well, this must be equipment expense. And also when we were doing deferred expenses, we credited the asset that we used up. So we will be tempted to do a journal entry like this, where we debit equipment expense and credit the equipment. Of course, we can't make things quite that easy in this case. And why is that? Well, in the case of supplies, let's say we used up supplies of $2,000. And so it looked kind of like this, where we debit the supplies expense $2,000 and credit the supplies of $2,000. When we credit the supplies, that's because we don't have the supplies anymore. They are gone. We can't get those back. The difference with this one is we still have the equipment. We did not get rid of $10,000 worth of equipment. We still have that equipment. So we can't actually credit the equipment. So instead of crediting the equipment account, we are going to credit something called accumulated depreciation. I abbreviate this A/D. So if you ever see me use A/D in the future, that's accumulated depreciation. Accumulated depreciation is what is called a contra asset. So we have a contra asset. What is a contra asset? Contra means opposite. So this is an asset that is opposite the normal assets. So if we look at this, now we have actually two accounts related to the equipment. We have the original equipment account of $50,000. And we also have this accumulated depreciation account that now has a credit of $10,000. A contra asset always belongs with something else. We might also have a contra revenue account. And a contra revenue account always has to belong with another revenue account. So contra assets, they cannot stand by themselves. They belong with something else. And whenever we show the accumulated depreciation account, we have to show it with the related equipment account. They go together. Now, what is this going to look like when we do it on a financial statement? Well, we are going to show, let me erase some stuff here. Instead of showing equipment of $40,000, we will show equipment of $50,000. And then we'll show less accumulated depreciation of $10,000 for a net book value of $40,000. So we still get to the $40,000, which is we used up $10,000 worth of this equipment. We still get to the $40,000. It's just that we don't want to show that we got rid of any equipment. We didn't. We didn't get rid of the equipment, so we still have to show we have $50,000 worth of equipment. This is also has to do with the cost principle in that we have to show things on our balance sheet at what we paid for it. So if we credited the equipment directly for $10,000, that would show the equipment at $40,000, which would be a violation of the cost principle because we didn't pay $40,000 for the equipment, we paid $50,000. So we need to make sure that we show the cost of the equipment of $50,000. And then we show that, well, the accumulated depreciation is minus $10,000, and we have a net book value. So that's a term that you will need to know, the book value of $40,000, which more or less is what the equipment is now worth. So depreciation, in general, if you hear that term, that means it's going down in value. And so we show that this equipment has gone down in value of $10,000. That might be a simplified view of what depreciation is, but that's what we're going to go with for now. All right, so that's one half of this, is that we cannot credit the equipment account directly because we still have the equipment. Instead, we're going to use a contra asset account called accumulated depreciation. We're also not going to call this equipment expense. We are going to call it depreciation expense. Just because we like making things difficult, right? So while equipment and other fixed assets, meaning the big things like buildings and furniture and equipment, all of these are technically deferred expenses, and we technically, like other deferred expenses, we debit some sort of expense and credit some sort of asset. We are not going to quite follow the same pattern that we did before. Instead of calling it equipment expense, we'll call it depreciation expense. And instead of crediting the asset directly, we need to use this contra asset account called accumulated depreciation. And just as a reminder, these contra accounts always must appear with something else. They belong with something else. So whenever we have the equipment account, it belongs with the related accumulated depreciation. They cannot be shown without the other. All right, so that's the special case of what do we do with fixed assets when we are doing adjusting entries.